Hello everybody. Welcome to this concurrent session. I'm Elisa Yao from SKL Actuarial, and I'll be chairing this session today. So today we have Luke Assar and Niro Maheshwaran, both from Finity Consulting, presenting on their findings on the paper they wrote on Australian private health insurance 20 years from now. So before we start, let me tell you a little bit about our presenters and their area of expertise. So Luke is currently a senior consultant at Finity. He has over 13 years of experience in general insurance and health insurance. He's an appointed actuary for private health insurers with extensive experience in investments, capital modelling, and consumer analytics. Luke has an interest in how survey data can be used to better understand consumer attitudes towards insurance, affordability, and health. Niro is currently a consultant at Finity. She has over 10 years of actuarial experience in various roles, such as regulatory, prudential, and data analytics. Her passion lies in enhancing the sustainability, efficiency, and effectiveness of Australia's health landscape, particularly within the domain of private health insurance, aged care, and public policy. I'll leave Luke to maybe start the presentation.
Thank you, Elisa, sorry. Just while I'm just waiting for the slides to come up, I would like to just acknowledge the traditional custodians of the lands and waters where we live, work, travel, and trade, and we pay our respects to the members of those communities, elders past and present, and recognise and celebrate their continuing custodianship and culture. Okay, so we're working on the slides, but look, what we wanted to do today was take you through projections of the Australian private health insurance industry over the next 20 years. Really, the motivation for doing this was some research that had come out over the past few years, as well as some kind of concerns from APRA, the regulator, around the sustainability of the industry from a participation and a cost perspective. And what we wanted to do was explore, really, the potential for the industry to kind of fall into this so-called death spiral. So what we've done is we've got a bit of an introduction to set the scene. Niro will take us through our best estimate projection, but acknowledging that a best estimate, there's various assumptions underpinning that. We also look at what could emerge under a number of scenarios around participation and inflation. And then we conclude with, we make our conclusions and also suggest future areas of research. So just introducing this concept of what we're looking at. So what do we mean by a death spiral? What we mean is unsustainable increases in premium rates leading to severe falls in participation, such that the industry can't work its way out, and it ultimately needs a major government intervention in order to retain or survive. What is the kind of driver of this? Well, firstly, the industry is community rated, so insurers can't set or deny coverage based on health status, age, gender, and characteristics which are generally predictive of PHI claims. So if we look at the diagram, that first point is that those people that are generally of healthy life, healthier than average, may perceive that they're not getting value out of health insurance, therefore they're more likely to lapse their cover. When healthy people lapse, the average cost of claims increases, which leads to higher premiums, which then leads to affordability challenges, which then completes the cycle and leads to a further lapse of healthy policies. Now that may not exactly eventuate unless you have some pressures on costs, but we do have sort of extraneous pressures on costs from an ageing population. So older lives generally cost more than younger lives, and the population is ageing. And healthcare cost inflation, which often runs higher than wage inflation. So when you kind of consider all of those things, a death spiral would seem inevitable, and indeed it has been a topic of research, particularly from the Grattan Institute, who'd kind of put forward in 2019 that this was where the industry was headed without significant change. And you can see that there's obviously been interest from regulators. So in 2019, APRA wrote to insurers expressing their concerns that PHIs lacked a suitable strategy for ensuring sustainability of the industry. So what we're trying to explore is, well, we also know that there have been some significant impacts of the COVID-19 pandemic on both participation and benefit inflation, which potentially has provided a bit of a lifeline or delayed any kind of potential for there to be a death spiral by a few years. But we want to really explore whether or not there's potential over the next 20 years and what factors would need to change to for a death spiral to emerge, and what should we be on the lookout for. So just exploring recent trends, this is showing, each line is showing the proportion of the population with private health insurance over time. Each line is a different age group. The yellow is showing the all ages. So really we're seeing participation hover between 45% and 50% over the past 20 years. But what's notable is that participation amongst the older cohort, so those aged 60 plus in grey, has increased over that 20 years, while the proportion of those aged 20 to 39 in blue has kind of hovered around the same level at 40%. In recent years, so just looking at the last few points of that chart, you've seen an increase in participation. Now, there are a few things driving that. Firstly, the COVID-19 pandemic created potentially a negative perception of the stability of the public health system and how it was managing larger waiting lists and dealing with the COVID pandemic. That improved the attractiveness of PHI and potentially brought people into the industry. But we've also seen some reforms for encouraging youth participation, particularly around age-based discounts and reforms for dependents to stay on their parents' policy for longer. Now, these factors are somewhat temporary. We don't think those effects of the COVID pandemic will continue forever. But the increases have probably persisted for longer than we would have thought, and there is great uncertainty as to how long the public system can operate at the current point, and therefore what the future PHI attractiveness will look like. Now, overall, the general trends in terms of higher participation amongst an older cohort will mean higher costs for the industry. Just showing a chart here which shows the average benefits per person by age. And the blue line showing 2008 and the yellow line is showing 2023. And you can see that certainly the older ages obviously have expected costs that are multiples of the younger ages. And so that's kind of where this concept of the death spiral kind of comes out of. So how do we actually define a death spiral, or what are the signs of a death spiral? I don't think the previous research necessarily quantified or gave exactly a benchmark of what we should be looking for. I've gone back to a paper from Andrew Gale. I think this is almost 20 years old now, but it's showing historical participation over time from a very long point in time, so from 1971 up to 2003. And I guess the period that we would consider reflective of potentially a death spiral was that period in the 90s where participation fell about 15% over 9 years. I don't have all the premium rate information, but I know that in 1998, premium rates increased by almost 7%, and in the following years after, similarly high rates. And it wasn't until the significant government intervention with the introduction of the Medicare levy surcharge, PHI rebate and lifetime health cover that participation recovered back to 45% where it was in the early 90s. So it kind of gets to the questions we want to try and answer as part of this paper, which you can kind of see up there, the potential and timing of a death spiral if we were to do a best estimate projection over 20 years. What are some scenarios that could occur, and does that bring forward a potential death spiral, or what are the situations that need to occur to lead to a death spiral? And are there factors that mitigate or accelerate a death spiral? And even for insurers in particular, what does that mean for different insurers that might have different age profiles or different rates of expenses. Look, it's a relatively actuarial exercise that we've gone through, but really what we're hoping to kind of show is that there's quite a lot of moving parts, there's a lot of uncertainty. Potentially it's alarmist to say that a death spiral is inevitable. There's certainly further areas of research that I think the industry would benefit from greatly in order to understand the future sustainability of the industry. I'll hand over to Nero, who will take us through our best estimate projection.
Thanks, Luke. So I guess, this is really quite maybe not the most interesting part of the presentation, but it's actually quite the basis of what we tried to achieve in terms of seeing whether we could generate a debt spiral to first get our best estimate. And so our model is, gone the wrong way. Our model is, very simple. Starts off with membership, models participation rates, and then goes to what benefits are like, average claim size, utilisation, and considers what the industry expenses are, and kind of just does a very high-level industry P&L projection. We do use what data is available publicly. So while we could do this at an individual fund level, I guess the purpose of the paper was to kind of look at it at the industry perspective and see what would cause that debt spiral. So if I just go to the next slide. So when we're doing our projections, I know over the course of the last 3 days, we've kind of learnt that historical experience is probably not the best way to model future experience. But in PHI, I found, in my experience, that before maybe 2014 or even 2017, a lot of the experience was quite stable. And so from 2014 to 2017, there was a little bit of a shift. So we did see that high level of benefit inflation. We did see some elements of the debt spiral occurring. A lot of aging, the aging inflation really started to kick in that period. But then the government did make some changes. So they did make changes to the way products are structured. So you're probably all very familiar with the gold and silver and the bronze kind of tiers, and that was kind of phased in from 2017 to 2019. And that had like a very kind of a gradual impact on the way people used hospital and claimed on their hospital products. So we did see a little bit of a lower benefit inflation in that period. And then before we could really see that experience eventuate, we did obviously have the pandemic, and that was a huge drop in utilisation. And what also happened, which is a little bit unclear as to why, is that even to this present day, we've still got a bit of a depressed kind of experience in terms of how much people are utilising their hospital products. So we're still seeing benefits being lower than expected, as if the pandemic would not have happened. And then also participation changed. So the way, I think in the previous slides, Luke did show that the participation rates were increasing amongst, that age cohort. But even the younger cohorts, like 35 to 39-year-olds, we do see, that increase coming through. So whether that's a perception on PHI products or hospital products is kind of unclear with the data that we have. So we did look at these 3 periods and try to kind of select and subjectively select which part of the experience that we should use to project. And so the next few slides really just show some interesting analysis that we found and the way we kind of projected and kind of presents those results kind of to show you that our best estimate model is not really unreasonable, but it is a simplified version of what, in terms of all the other factors that you could consider, it's still reasonable considering it at a very high level. So this one is really interesting. I think I'll just kind of unpack what the chart is showing. So if we just take just that yellow line that's a little bit hidden and look at the most interesting data point, which is the 50 to 54-year-old, that point, that is the participation rate for 50 to 54-year-olds in 2007. So it's just hovering under 60%. And you can follow that point across each other coloured line, and each other coloured line represents 5 years in the future. So the blue line is 2012, and that point's just moved a little bit closer to 60%, and then after 5 years, it moves a little bit down, but still kind of quite stable. And I think the most interesting thing about this chart is it kind of shows that participation rates actually don't move that much for an age cohort. So once, an age cohort has decided they're going to purchase PHI hospital products, they basically remain in that market. And so when we're considering, a debt spiral and membership decreasing or participation rates decreasing, we have to think about where would that come from. It would usually just come from, the younger population or the population that's, closer to, 20 to 40. I'm not sure about you guys, but if I look at my parents and my in-laws, they tend to stick to their cover. They stick on the cover they've had for a very long time. They're probably on a closed gold product, and so this kind of is kind of demonstrating that. The next thing that we did, so we did do obviously the average claim size, but the utilisation is actually one of the challenging things to project, and the reason for that is because of those 3 distinct periods that I was talking about before. So you've got that 2014 to 2017 kind of flattening of some of the utilisation, and then you had COVID, which was that big drop in utilisation. So when we are looking forward, we're trying to think, well, how much of the drop is, going to come back, and how much is sustained because, well, there have been so many changes in the last, 5 to 10 years. Another thing to point out in this chart is you can see our forecast is roughly, I would say a reasonability check. It would pass that. So, our assumptions are kind of sense checked with these kind of projections at an age by age level. Sorry. Okay. So then what we did look at the end of our projection, as well as, for forecasting, is what was the benefit inflation like. So we broke up benefit inflation into 3 components. So the ageing impact, so that we looked at, well, if the age profile has stayed the same, changed, but the average claim size for that age profile has stayed the same, what was the impact of that year on year? So that is the yellow bars. And then the blue bars are the change in utilisation. So that can be quite volatile, and that is really, again, the challenge in projecting the future 20 years. And so you can see during COVID, there was a lot of negative utilisation just because, the government did limit elective surgery, and people were hesitant to go and do elective surgery and postpone those things. Obviously, we've seen a kick up in 2023, and so how much of that do we expect to still come back was a challenge to forecast, but you can see our assumptions there. It's pretty stable, is our view. The ageing, so our forecast does assume that the ageing impact is reducing over time, and I just refer back to that cohort chart, and that it is because of that high participation rate of those 55 to 59-year-olds, and how that kind of goes through the population. We just don't think that it's going to age as fast as it did during that debt spiral period. And then the last element that we kind of reviewed was the risk equalisation impact. So risk equalisation is kind of the function that allows for community rating in private health insurance. So it's the proportion of benefits that is shared amongst all insurers, and it's based on benefits over the age of 55, and a certain proportion is shared with the whole of industry. And you can see, we are forecasting that is going to go above 50%, so more than 50% of the benefits in the private health insurance industry will be shared. And I think the important thing about risk equalisation at industry level is that it does impact premiums and pricing. So if you think of a basic product or a bronze product where the participant is less than the age of 55, their costs are not going to go into the pool, they're not going to be shared into the pool, but because they kind of exist as a policy, the fund is going to have to pay a premium for that member. And so that means that whatever funds, whatever benefits are being shared into the pool, divided by how many policies weighted by whether they're singles or couples, is going to impact the baseline price of a product. So I think that is what's kind of important for the industry, and that's why we kind of see a little bit of rhetoric around whether younger people are paying for older people and subsidising that cost. It's because of that risk equalisation facility. And then I guess the whole point of the exercise was to see what would we need, based on all our projections, what would we need for the industry to achieve a net margin of about 5%. So we thought we'd give the industry the opportunity to earn 5%. That would, on average, that looked historically consistent. And what would that mean for premiums based on all our forecast assumptions on the best estimate level? So at the end, I guess you can see that line, it kind of hovering around 3 to 3.2%. So that is our estimate, our best estimate of what would happen in the future. So I just want to stress, this is the best estimate model. This is very high level, very simplified. And the purpose of it was to kind of go, well, if we just took these long-term trends that we are seeing in private health insurance, what would that look like? But then also, what could we do to kind of generate those debt spiral scenarios? So we needed a starting position, and this was where we started. So I'd hand it back to Luke to kind of talk to the scenarios and kind of what he investigated on top of the best estimate model.
Thanks, Nero. Just before we get into the scenarios, the one thing that we also had to consider as well, that projection of premium rate increases that you saw kind of assumed a starting point for participation over time. And what we wanted to do was kind of circle back and say, well, if you estimate that is the level of premium rate increase needed, is there a circular impact back on participation? So we would have thought that if you had pretty high premium rate increases projected, there'd then be a compounding impact on participation that would kind of generate this death spiral. Our conclusion, though, was that 3.2% on average premium rate rises are not really enough to generate significant changes in participation. Really, what we've struggled to really see a strong relationship between price increases and premium rates in private health insurance. And the reason for that is, well, the chart that we've shown here, the grey bars are showing the participation over the past 20 years. The green lines are showing the change in the cost of living index. And you can see that there's some periods there, particularly in the late 2000s, where participation was increasing while that cost of living was relatively high compared to the average, and then participation falls when that cost of living index is lower. We haven't yet seen, or potentially it's too early to see the impact of that really significant increase in the cost of living over the past year on participation, but certainly haven't seen anything to December 2023 that suggests there's a strong link there. There's also some other research based on survey data that suggests there's not a very strong link between price increases and participation, and part of the drivers of that also relate to some of the government incentives. So the Medicare levy surcharge, which encourages participation for higher income earners, and the lifetime health cover, which really also incentivises people to retain cover for the remainder of their life. So all this to say really is that there's not a clear-cut strong relationship between premium rate increases and participation. And so based on this, we don't think that a 3.2% on average increase would have material impact circling back to participation. So therefore, we're really projecting overall, our best estimate is for a small fall in participation from 47% to 45% overall. The average age of the insured population is projected to increase, but at a slower rate than prior to the COVID-19 pandemic, from when it was increasing there, and for premium increases of 3.2% per annum. So as Nero mentioned, none of this would be indicative of a death spiral under a best estimate scenario, but of course, we ought to consider other assumptions and explore what assumptions would lead to such a scenario. So many of the scenarios we considered were around participation and benefits. So the chart on the left is showing our scenario participation rates. So the yellow line is our base participation by age. The blue line shows our best estimate projection by age, sitting under the grey line in the older years. And then the grey line is showing how we stressed it. And really, we just wanted to stress that youth participation such that 25 to 29-year-olds were down at around 10%. We think, keep in mind, because of the Medicare levy surcharge, there is a bit of a flaw, and it's but looking at ATO data, 10% may be close to that flaw. We also stressed benefits. So our base projection is really looking at a combination of benefit or utilisation and average claim size inflation, considering pre-COVID experience. The benefit, the stress scenario really considers kind of the worst of that experience between kind of 2010 and 2017. So these are our scenario results. I guess the key things to call out. So after the base, we did do an increased participation scenario, but following that, we look at the lower participation scenario. Really, if you look at what impact that would have on premium rates, it's not a really significant increase. So we're talking 3.2% per annum to 3.9% per annum. It's also worth considering the impact, the interaction between participation and benefit inflation. So if you look at that lower participation scenario, the benefit inflation being projected is about 3.4%, which is lower than under the base. That's because, at least in our best estimate projection, the inflation rates, the potential for higher average claim size and utilisation is stronger under the younger population than it is for the older population. And so if you have a different weighting of age, that kind of comes through. The benefit scenario had a stronger impact on the future premium rate increases than the participation rate scenario. And when you combine both of those together, you do end up with something that starts to resemble a death spiral. But you've got to remember, this is probably looking at taking some of the worst years of participation and benefit inflation experience and assuming they continue for a 20-year period. So we're kind of projecting premium rate increases of 5.5% under that scenario. I don't think I've shown it here, but the benefits shared across the industry through risk equalisation increases to about 55%. And in order to get to that point, it means that the contributions into the pool per policy have to grow at around 7%. So that's potentially where the death spiral does emerge, where you get 7% increases on your contributions into the pool. Therefore, your basic and bronze products, which are generally attractive to the younger population, become 7% more expensive year on year. That said, this is, again, over a very long period of time. We also considered what impact differences in age profile for different insurers would have on this projected premium rate increase over time. So that's shown in the last two rows. Interestingly, whether you had an older population or a younger population, there wasn't a big difference in the premium rate increases needed. And I guess some of the motivation for doing this is some funds that I work with have different profiles to the industry, and they are interested for them what a longer projection would look like. If you're a fund with larger expenses as well, because I guess we're projecting expenses using CPI and wage inflation, both of those things are projected to grow at a slower rate than benefit inflation, and that means an insurer with a higher expense ratio, they can manage their expenses to grow in line with inflation, has maybe an opportunity to put through lower premium rate increases. So I just wanted to turn to conclusions overall. I guess when we started the presentation at the introduction and kind of when you look through some of the earlier research, it would seem intuitive that an ageing population combined with healthcare inflation would inevitably lead to a death spiral for PHI. But we hope that we've shown that there's actually more complex and uncertain movements, particularly around participation and benefit inflation, that mean a death spiral is definitely not a certainty. So some of those areas of complexity I've put up there. mainly around, well, youth participation. We've seen increases in that, and I don't think they're fully understood. There are perceptions of the public hospital system which are driving PHI attractiveness and participation. It's not clear how long that will last for, but it's certainly a driver. Utilisation trends, certainly COVID-19, as we saw in the charts, had a big impact, immediate impact on utilisation. There was a catch-up, but since then we've still seen utilisation at low levels, and we've certainly not seen them increase back up to pre-pandemic trends. I guess we don't have a clear driver of that as yet. Without really understanding what the driver is, it's difficult to know for how long that prolonged lower utilisation will continue for. Even if we consider the experience prior to the pandemic, there were clearly some signs where utilisation was flattening or even decreasing for some ages. And so there's certainly just not a certain rate of inflation for utilisation that'll continue forever. We've also shown that there are cohort effects with respect to participation that actually mean that the impact of ageing on benefits will be smaller over time as the current, the older cohort with a relatively high participation rate ages and over time. We've also called out that movements in prices don't appear to have a strong impact on participation because of low price elasticities. We also found that RBA put out research that recent changes in disposable income, they're not uniform across everyone at the same rate by income level. So I think that actually found over the past 3 years that while overall disposable income had decreased, it actually increased for those at the lower levels of disposable income and decreased more for those at higher levels of disposable income. And if those at higher income levels are more incentivised to take out PHI through the Medicare levy surcharge, then it suggests that there's potentially a positive impact from changes in disposable income recently. Also just called out the impact of the Medicare levy surcharge and lifetime health cover, which also may dampen the impacts of premium rate changes on participation. Just that last point there, though, is important. It doesn't mean there's room for complacency for the industry. Firstly, over the period of data that we've considered in forming our projections, the industry has benefited from a number of benefit reforms, in particular to prosthesis, that have kind of pulled back some of the benefit inflation. And effectively, our projections kind of incorporate some of this effect. So there is a bit of an underlying assumption that there will be proactive management of future benefit cost blowouts. There's also been some innovation by insurers and private hospitals in terms of providing more efficient forms of care, like rehabilitation in the home and other hospital services provided in the home, monitoring after procedures, better diagnostics, telehealth, health management programs that potentially have led to lower benefit inflation, and some of that would be baked into our projection as well. Although we've shown that differences in age profile don't significantly impact required premium rate increases, those insurers with higher age profiles tend to be more reliant on the current risk equalisation structure, which is not guaranteed to stay the same over the past 20 years. We've also not really assumed any change to policy settings other than the minor kind of potential benefit reforms that are kind of underlying our projections. So while the government appetite for PHI reform at the moment doesn't seem very strong, they have in the past 3 years commissioned a number of reviews into Medicare levy surcharge, risk equalisation, the PHI rebate, and as mentioned, there's no guarantee that there won't be significant reform in the future. We also don't really consider one-off shock events in PHI. I mean, we saw that a pandemic was a favourable event for the industry, but there are potential one-off shocks that could kind of have a negative impact to the industry. We haven't really considered those. So all of that is still worth considering by the industry. And look, there's a whole raft of other changes over the next 20 years. Our paper tried to show that there's already some complexity when you're doing a really data-driven actuarial approach. but it doesn't really consider the areas of innovation and change in the environment and industry that are foreseeable. And I think it's really worth us as a profession exploring many more of these and what they will do to the industry. Some of the examples that we've seen in preventative and integrated care, as I mentioned previously, what will it do when there are a number of, I know that some of the larger funds are putting in rehabilitation at home, monitoring, trying to limit the extent of readmission. Changes in services. Will consumers use hospital services differently? Some of our projections for utilisation amongst the 30s for them to decline slightly over time reflects a declining use of obstetrics in private hospitals, but there may also be other services offered. I've seen examples of, in orthopaedics, of kind of non-invasive procedures that can kind of delay or maybe prevent the need for a joint replacement. I've mentioned policy settings, so any of them can change over the past 20 years, and we do kind of have some research in place to explore what those changes could be. The product tier system, so Nero mentioned that we think that has had a bit of an impact on benefits potentially in the last few years. It's difficult to see exactly how that has played out. I know the Department of Health only a couple of weeks ago released data that showed the actual mix of product tiers, participation by product tier, and it did show that there was a move away from gold into silver plus. So is there more personalisation of the health insurance product that consumers are trying to kind of get for themselves? Benefit reforms, I've mentioned prosthesis. We've kind of seen recent Four Corners investigations on the effectiveness of certain pain management procedures. And then population health. So population health is obviously changing over time. I guess as well, part of that is, and what I would like to see more research in is this kind of, how well does the public understand their need for healthcare? I think part of the death spiral assumptions are that a healthier population will lapse their cover, but how well does that healthier population know their health status? I saw research that through Ipsos and Members Health that their view was that actually the public has a pretty optimistic view of their own healthcare needs. So I would like to explore a bit more as to how perceptions of healthcare for an individual will affect their likelihood of participation. And yeah, that concludes what I wanted to talk about. Thank you.
Thank you. Thank you, Luke and Nero, for sharing your findings. So it's definitely encouraging to see that the death spiral is definitely not a certainty, but definitely a lot of challenges ahead still. So it's Q&A time. So just a reminder to submit your questions on the Summit app, but we already have a few questions that have already come in. I would say a lot of the questions I think everyone's quite interested in is the observation that the participation rates are being propped up by regulation and policy. And I think the audience just want to understand, is reform or regulation the only way to address this? What other prospects will there be further government intervention? What are your thoughts on that?
Yeah, so I guess the comment is that is there a way for the industry to support itself without government incentives like the rebates, MLS and lifetime health cover? I think probably not under a community rated system. So in a system where we want to sort of charge the same premium regardless of healthcare status for the same product and encourage access to that system, if you have that in place, it does naturally create challenges in retaining members into the industry that you want to retain in order to kind of keep costs low. So I think those are kind of important government incentives that are necessary to support the sustainability of the industry. They all kind of work in different ways. I mean, Medicare levy surcharge does bring in people to the industry, whether they feel like they value private health or not. Lifetime health cover, it can kind of, we did a bit of work for the Department of Health, it can kind of encourage a little bit of participation for the under 30s, but importantly it also encourages people to retain cover as they age, and also kind of prevents people who are kind of starting to know that maybe they might need a service to kind of take out cover and kind of hit and run. So I think overall those incentives are important for sustainability. Yeah.
Do you think as it goes on throughout the next 20 years, if participation, for example, start decreasing, the government might intervene further with further reforms or regulations that would encourage to retain or to join in the participation rates?
I do think that the government supports the private health insurance sector because I think they need it. So I think if they didn't support it, they'd have to restructure their current public health system to accommodate, the services that are not going through private health insurance. So I do think that they do support it, and it does look like it's on the legs of government reform, but I think it's part of a bigger picture, and so that support, I think even in the modelling, you kind of do assume it's implicitly there, and that will sometimes, kind of come in cycles. Yeah.
Thank you. I think that leads to maybe another question from the audience. Do you have any thoughts on the balance between people taking up PHI for tax deductions purposes versus potential loss of revenue to Medicare?
Yes, we have done some analysis on that so the ATO do publish, you can look at by income band what the take-up is, or the rate of those taxpayers who say that they do have health cover, and you can look at it by income as well. I think what we tried to do was kind of look at that, how participation changed with income before the Medicare levy surcharge kind of came into effect, so at lower levels of income, and sort of tried to project what that would be. I can't remember off the top of the head the answer, but I did have an answer as to how many are in there, because there's kind of a tax incentive rather than an actual value of the product for the price.
Yeah, no, all good. I think just a few questions on the data that's been put forward. An interesting one is, does the stickiness for each cohort mean that pregnancy rates put a floor on participation for private health insurance, assuming a certain percentage will use the private system, health system, when planning pregnancy?
Yeah, so that pregnancy rates are decreasing over time. So then we have lower younger cohorts coming through. We used ABS data, so I think that the implicit assumption is there in their population forecast. But I guess the implications are more important. So based on that forecast, we would say that, in the next 20 years is probably not a problem, but maybe longer term, definitely like declining birth rates does mean an ageing population. But I think that, again, has an overall implication for the Australian population in many aspects, so not just private health insurance, but even in the public health system, and just also the way things are treated through Medicare and things like that, with chronic conditions on the rise. So I would say, yes, it definitely has an impact if that ageing continues, but maybe for our scope in the next 20 years, it wasn't as evident.
I think it's an area too that I'd like to do a little bit more research in. It's like looking at a customer lifetime value. So we've seen that the kind of popular, the common benefits that are claimed amongst a younger population are obstetrics. We've seen mental health or psychiatric hospital as well. I guess they tend to be expensive for a health fund, but I would like to better understand, I guess, what's the overall value of providing those products. If you can bring people in their 30s into the industry by offering very inexpensive pregnancy cover, is there a payback period for that? Do they, over the long run, pay that back because they stick around for a long enough time? I think it's hard for an individual fund to do that because people will switch funds, but if there's a way that the industry can kind of quantify that can kind of be, I'd be very interested in seeing it.
That's definitely going to be an area of interest, as you say, especially with the global trend is to be having less babies, so that can impact on that. I think maybe just got time for one final question. Is there currently a death spiral in the gold tier hospital cover? Just to wrap up.
We do know a lot have closed over the last 3 or 4 years. The premium increases on those are, more than 5 to 6%, whereas the other products are around 2 to 3, even 3 to 4%, but less than gold. And in my opinion, and I think Luke will probably have more to add, but my opinion is yes, maybe without government intervention it will be, because funds do find it quite an unprofitable segment, especially as I guess people learn that they can go to Silver Plus products, pay a lower premium, and get the benefits that they are looking for. And so what you have is a natural adverse selection, and people wanting gold. You do have the cohort that are looking for peace of mind cover, but more and more people are getting smarter about their insurance, and so then you do have that bigger impact of adverse selection. So people actually looking at gold and saying, well, yeah, I'm going to buy this product because I want to claim on it. So my view is, yes, it is in a debt spiral. I would say, like, based on the trends, we at Affinity we do a bit of a market scan every quarter, and we do see that the gold products available, especially for the open market, is reducing. There is actually no nil excess at the moment that's open, only on restricted funds. So yes, I guess the short answer is yes, but I'm sure Luke has a bit more to add.
Yeah, I sort of think it's got a different value to funds than maybe some of the other products. So if you look at so it's the Private Health Insurance Intermediaries Association, their annual report shows the mix of products by, mix of sales by product and by age. And so maybe perhaps surprisingly, gold is more popular amongst the younger population than the older population, because you can get Silver Plus that's reasonably comprehensive, that doesn't have pregnancy. So gold is really your cover if you want pregnancy again. So I think that it might serve a different purpose. There's certainly an older cohort that have retained their comprehensive cover over time. We're seeing that decrease over the past few years with the introduction of the product tier system. I think it'll have to think about who a gold product is for and what value it brings to funds for offering a gold.
Definitely. Thank you. I think we've run out of time. This is the end of the session. Thank you for staying and having some of these questions and participating. But let's give a round of applause for the presenters, Luke and Neuro.